talk often about how important the quarter end, year end effect is in financial markets. Here we are at the end of the third quarter. And so let's do a third quarter recap and do this by going back over our Golden Oldie charts. There's a number of interesting charts that have served us well over the course of this year. So let's look back at those charts, bring them up to date. And here we go. My name is Bruce Fraser. Welcome to Power Charting. Goodbye third quarter. The Nasdaq 100 had a great third quarter, but it was even better at around the August-September peak. So still pretty impressive. These performance numbers are midday on September 30th. And so the final numbers are going to look a little different from this. But just to have a gander here at these, and you'll see the most interesting is, of course, the year-to-date performance of the Nasdaq 100, which is the incredible growth stocks. Look at the Philadelphia Gold and Silver Index, the XAU. We have been really focused on gold and silver commodities and stocks, and really has been a stellar performer in the year and the quarter. The S&P 500 had a really good third quarter and took the index positive for the year. The Dow Industrials are still negative on the year, and this is interesting. We're going to look at a chart of that. Transportation average is heartening because it had a really good third quarter, which suggests that trucks, trains, and airplanes are starting to move goods. This could be a precursor to a recovering economy, and we really like that. And it also brought the transportation index to a positive number on the year. The lowly Russell 2000, which is small caps, we know how this has gone in the year of COVID, that small caps have tend to be somewhat harmed by the COVID and the slowdown of the economy. And so the Russell 2000 continues to lag. Now, this chart here is our election year chart, 116 years of data, but it's only the presidential election years all summed together into a seasonality chart. We've talked about this chart before. I'm just going to focus on a couple of things. One is the month of August is the best month of the year. And in fact, it was an exceptional month. This is where the performance largely came from these indexes. Well, look what happened. A really sharp advance with a climactic surge into the end of the month and the beginning of September. We'll look at a chart and see how that actually went. Thereafter, an important reaction with a low that shows up in October. Now, here we are at the end of September, and we'll look and see whether or not there's any indication that we could get a further lows into October. But with a test and then higher highs into the end of the year. Now, this is an election year. A lot of things can happen. We just had a discussion in the Wyckoff market discussions about what happens if, in fact, the election results get delayed, which very well could happen, and how the market might react to that. So we're going to be watching very closely for really a gap of information that comes after the election, the possible uncertainties that come with that. So the end of the year here could be somewhat different. And in fact, there are variations in the data after elections, depending on whether or not the incumbent wins or loses, etc. So there's some good studies on that, maybe a discussion for a future episode. The NASDAQ 100 here is the decline, January, February peaks into the March lows. Look at this beautiful advance trend channel that is so well defined and so well trading in here. If you just early on where these X's or these boxes are, had drawn the reverse use of trend lines and the oversold line and used that for establishing your trade entries, this would have been an exceptionally good but very straightforward tool. So this chart is a chart that we looked at very early in the year, and we had been keeping it up. We haven't looked at it in a while. I want to show you the August advance. Here's August. Here's the climactic surge, and notice the reaction. So climactic high, that's resistance, support, and here we are in a range-bound condition. Potentially, we're looking at a possible rally here. The market is up right around here at this point. And so is there a possibility that we could rally back up to the climactic highs for a test? Of course that could happen. So, but also notice that the market continues to be weak through here. And so after this rally up to this resistance zone, which is also rallying up under the oversold line, this could be a classic place for a rejection of the index from that level and take us back down to the potentially to that October lower low that sets up the rally into the election. Here's the Nasdaq 100 again. This is a 60-minute chart focusing really on this classic use of trend lines. This is a demand line here and here, overbought line. Again, it works pretty much the same way as on the daily, even though it's reverse use before. Buying climax, automatic reaction. You can see it here in the hourly quite well. Resistance, support, all the comments we just had. Now this chart is up through midday, end of the quarter, September 30th, and you can see that we're right up into this resistance zone right here. So this would be a classic place for the market to come back down for that potential October low. Now, here is a very interesting point and figure chart of the Nasdaq 100. This is a percent scale chart. Each box is 2% from the prior box, up and down. So along here, this is all 2%. This is a log scale chart. So hourly data and beautiful accumulation structure that really encompasses all of the month of March. And so does the Nasdaq 100 tell us how far it wants to go in this point and figure chart? 29 columns, 2% scale, one box reversal method, 60-minute data. Look where it takes us. It takes us from this count line, which is right at 74.80. It takes us up to a whopping 12,031, 13,283. So a really big move off of a beautiful accumulation structure. And notice how we draw a reverse use of trend lines, a beautiful channel here, shows up in the point and figure just as it did on the vertical. And at the end of the move is a very well-defined climactic surge that goes right into the middle of our objective range. So it takes us right up to 12,272, right here, right into the heart of this zone, and then sharply turns down and out of the channel. The most important reaction that we've had in the Nasdaq 100 since the COVID decline. And is it possible that we are now setting up a range-bound condition, building another cause, potentially for a move up or potentially for a move down? We have to wait and see how the cause forms, which is classic white coffee, and stay tuned, and we will keep an eye out for that. Here is the Dow Jones Industrial Average, and again, this is the April-May stride, 60-minute data, classic demand line construction. You can see that there's much less momentum in the rise up. Here's the August advance. Much less momentum in the Dow than there was in the Nasdaq 100. So it rides along the demand line. The demand line becomes a form of resistance in the uptrend right here, and then it can't even get back to the demand line and then falls away. So you very clearly the The result of this advance is a slowing Dow. Now, is there potentially a distribution type structure that's in some state of forming here? Well, it's very possible. And so here you can see a bit of weakness takes out this level. This is the June high, which is climactic in its own right on a smaller scale, but there's a gap here. And then it consolidates at the overbought line, it throws over slightly, and then fails back down to the bottom, and thereafter the momentum slows. So here we are at this June resistance and just sort of bouncing along there. This is midday June 30th. The Dow closed about 100 points lower, I think, than this number, but we'll see. So anyway, this could be some kind of a larger form of sideways trading range. Potentially, it's a reaccumulation, but so far, we don't have much indication there one way or the other. Here's a daily chart of the Dow, and this goes back to a trendline construction back in June. Now, I'm making a point with this, so I'm going to show you ever larger time frames with my Golden Oldie charts. This is a Golden Oldie chart, and you here see this demand line, and we keep track of these. We go back and constantly refer to them because they can be very helpful. Well, here's the COVID low. Here's the rally we just evaluated. Well, look at where the rally in the Dow stopped. This is a climax of sorts in the Dow where it runs up in August, accelerates into this trend line, and then rejects the trend line and now is showing weakness, and this is the area that we just evaluated. So we can see that it's unfinished business, and we have the potential for the year-end strength with the presidential election year cycle, and so we're going to be watching for that. We're going to be watching for a potential October low in this data, but now this trend line has served us very, very well. I also just want to point out two important point and figure counts that we won't look at today, but these counts both confirmed each other and gave us a beautiful count into the January-February peak where the market ran out of gas and we had the incredible COVID decline. So we've retraced most of that loss, pretty impressive, and of course we know what the Nasdaq has done. Now, this is a really important idea that I want to spend a few minutes on because now we're moving out into weekly data, and there is a market here. You know, the charts tell us everything. If we just let the markets charts talk to us, they'll tell us what's going on. We are in a trading range market since the beginning of 2018, and this market is bounded by a broadening structure, a broadening formation, higher highs and lower lows. This is a market that is facing extremes of emotions, the extremes of optimism and pessimism, fear and greed, euphoria and panic. These are all elements that are at work here. And we call this a trading range, but it's so dramatic. And it's a polarized market. Investors are polarized, and we're going through these psychological extremes. So here we can see with the buying climax, this was an epic buying climax. We're looking at the Dow, the S&P, and has its own version of this, and we'll try to look at this if time permits. Buying climax in January of 2018. In 2 weeks, a 12+% decline. So this sets up a range-bound condition, buying climax automatic reaction. Quite dramatic at the time. We talked about it, wrote about it in blogs and so on. Then a rally. This rally goes up and makes a slightly higher high. We're calling it a secondary test, up 15+%. So a very important rally goes to a minor new high and then falls very, dramatically in the fourth quarter from October to December, 19+% decline. So again, the market is becoming ever more volatile. It's like a skier that's going down a steep hill and all of a sudden a steep slope, and all of a sudden there's a twitch in the skier's skis, and the skier reacts to that, adjusts to that, and the adjustment creates an overreaction in the other direction. And the skier then tries to react and adjust to that, creates an overreaction in the other direction. And so each one of them becomes an ever larger event, and the skier is trying to just stay up. And so here we can see the 19% decline, and then in the year of 2019, a rally forms that goes up to an upthrust above this broadening structure, which is drawn on these 2 points here and here, and upthrusts that with a 36% advance. And then of course, this is the January, February peak, and the COVID decline, which in about 6 weeks goes down a whopping 38%. So we can see the ever widening, bounding structure of this trading range. And now we've had a rally, an epic rally of 60% on the Dow Industrials, much more so Nasdaq stocks, the growth stocks. Notice here, we're looking at these different trend lines and how in the case here, the Dow is run up to this trend line and it's reacting off of it. So it found it, reacted off of it, it's back below it, it's back into this widening megaphone, reverse symmetrical triangle, broadening formation. Let me just read to you this couple of sentences from Investopedia on broadening formations, which you can go look up. There's much more on this structure there than what I'm going to read you. The price may reflect a random disagreement between investors, or it may reflect a more fundamental factor. For example, many countries experience broadening formations due to heightened political risk ahead of an upcoming election. Different polling results or candidate policies may cause a market to become very bullish at some points and very bearish at other points. So here we have, from the beginning of 2018, is this market anticipating the polarizing events of an election? And this, I believe, in all of our experiences, is an election cycle that has polarize the electorate in not being political at all, but just recognizing that this stock market structure might be reflecting the opposing views of the different extremes of the electorate. And so I'll leave that for you to consider, but this is a market that's basically in a wide, volatile trading structure, and normally a broadening formation is considered to be a bearish event. Once it's completed, the market tends to go down into a long, prolonged downtrend. Does that have to happen? No. So let's look at an example of the alternative. I'm going to go quickly here. I'm running out of time. And so this is a chart I put up back in March. If you go look at my blog post, Where Were You in 62, which was in March of 2020, you can see these charts and bring them up to date. Now, I basically lined these up. So here's a broadening formation back from 58 to 63 and a shakeout low. And then I lined up the current market back in March and got it pretty right where this was about the low. It turned off of this falling line under the market, the lower trend line, and then it turned up off of that, which is the chart we just looked at. And here you can see the same thing, shakeout low down 27%, rallied, tested, and then rallied all the way to the top of the broadening formation. So here, this is about, on this point and figure chart, this is about right here. So you can see there's a point and figure count. Now this is the 62, 63 market, but you can see that after consolidating at this level, it rallied up. This was the first time the Dow got up to 1,000. And this point and figure chart did a wonderful job of identifying the extent, the potential of this advance. So the big question becomes, is that possible for the period to come? Of course it is. So it doesn't necessarily mean that a broadening formation has to result in a bear market. As a matter of fact, this big decline where we had the COVID decline here, this was the decline that was associated with the Cuban Missile Crisis. And so once it was resolved, as the COVID will be, the market was able to turn back up. And so here is potentially where we are now. The Dow's at a slightly lower high right now. So this is what maybe it's like right here in this analog. Maybe this is the reaction into October and then the rally into the end of the year. And so that could very well be what the analog is saying. And then, of course, this big, beautiful advance that goes all the way into 1966. So let's be hopeful for that, but let's also be really good Wyckofians and make sure we're letting the tail of the tape tell us what we should be doing. So with that, here's just the S&P. I'm going to go through these golden oldies quickly here. Broadening formation, you can see that the S&P has gone to a slightly higher high above the high that was made in January, February. This is the end of the year 2019 right here. So you can see it's flirting. This is September 25th. It's flirting with unchanged on the year. Broadening structure, but a higher high in the S&P, and that's because it has more of a Nasdaq 100 growth component in it than the Dow does, but the Dow has some. So the other thing I want to really point out here, let's get rid of these markings, is this very long trend line going back to 2016. So you can see the stride was set in 2016. Look at how beautifully this worked. Touches throughout the 2018 period and then falls through. Can't get back above this demand line. Normal use of trend lines, throws over January, February 2020, throws over here and then is rejected and it's back below. So again, this is an existential moment in the markets on this trend line also. So the further out in time we go, we see these trend lines are all at important points where we could be on the cusp, we could be on the edge here. And so we need to really pay attention to this very moment in the markets. This is just the Vanguard Value Index, which shows the broadening structure. Here's the 2018 buying climax. Look how beautiful this is. And then here's resistance that forms at the buying climax. Well, my gosh, look where we are. And so right here, we're in a position where it's pulled back below. This is also a moment, a period, a point of potential risk for the market where it's vulnerable after an extremely strong run where it's technically overbought. Here's the fear and greed index. I put this up because I want to really focus on the idea of the emotions of this market. So here you can see the emotions of the Dow Jones Industrials broadening formation. This is through the 25th, and the touch of this higher trend line, rejected off of that, turned back down. It's now back down to where the resistance area is. Very interesting place for the market. But I want to use the CNN fear and greed to really illustrate the extreme emotion that's been in this market since 2018. So you get around the 80 level, that's extreme greed, they call it. Optimism is another term to use. Extreme fear down here below 20, almost to zero. The acute fear and pessimism that's shown up in these markets here and here and here really show up in this index. And this is available free for everybody to look at. Recently, we got as high as 77 at this level, and you can see this is about where the tops come in. And so there is a very emotional market here that shows up in this data, and here is the visual reflection of that in the price chart, which has basically been trendless now for a number of years. Here is the put call data. We have been talking about this data. This was historically extreme data. 10-day moving average is the green line. This was a very high data back in January, February, a very high optimism, bullish speculation, which is bearish, inverted thinking to the market, and resulted in the very sharp COVID decline. Well, here we are. This is even bigger and deeper than it was back then, and that was historic. So here we are again. We've been telling each other this really in the last number of episodes of power charting to look out, and this really has reached an extreme all the way back to June. Okay, New York Composite. Again, we're looking at monthly data. Here is an important demand line, normal use of trend lines. This is back. This is the 08, 09 bear market low. Look at how it turns off of that, and we have a beautiful bull market run. Well, this is quite advanced run in this market since 09. Well, this big COVID break has taken out this demand line pretty substantially. And now we have a rally that basically goes up to the demand line, and here we are. And so there is another form of existential risk or at this level here. So, and also notice how the New York comp is not nearly as strong as the S&P or the Nasdaq 100. So big broadening formation, and it's got that big trend line there. So again, something for us to keep an eye on. Again, I still believe the 62 analog is a very real possibility. And so I've got about a minute and a half left. Here is a yearly chart. Look at this. This is a normal demand line construction off the 42 and the 73, 74 low, and overbought line drawn here. Here we are. We actually put this chart up in 2019. This is a real golden oldie for us. And we said at the end of the year, wow, look at that. It's pushed up against this overbought line. That should be good resistance. And then look at this huge bar that we've had, yearly bar, and we've rallied back up, and we're right back on that overbought line. Really interesting place. So can we get the market to basically go sideways or right along the bar like it did here? Okay, I'm going to skip this chart. You can take a look at it, screen captured. I just want to show you on gold futures. We have 30 seconds that we talked about. We did a good job, talked about how this market could run up to the 2011, 2012 highs. It's done exactly that with a climactic bar, and look at this big tail on this bar and a turn off of that. Classic resistance, we would expect that. I want to show you a chart I did back in February of 2019. This is 4 segments across here. This gave us a count 1800, 1920 that we put in at the time. Pretty darn good chart. And so there is so there are other counts. There's much bigger potential here. And I just want to show you this. There was 2 more columns that were added on that first segment. Took us right up to that 1900, 2120 level. And we've climaxed right into that. And so here we are, going sideways, hopefully building another cause for another move in a really great campaign. And with that, I'll say goodbye.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.